Best greetings to you. How are you doing? I believe you're doing well. Now, today we are going to talk about institutional market structure. We are building on what we've learned in our previous video on market structure. Remember, swing point, three candle pattern. Yes, three candle pattern. 1, 2, and 3. This one that sticks its leg out, the lowest candle with a wick, look at it. That's the swing point of this three candle pattern. 1, 2, and 3. This lowest one is the swing low. Then when we go up, we have this. This is the swing high. 1, 2, and 3. Good. Now, this is another swing low. 1, 2, and 3. Now, an intermediate term low is the lowest swing low that has a higher swing low at the right of it and a higher swing low at the left of it. I repeat, an intermediate term low is a low that has a higher swing low at the right of it and a higher swing low at the left of it. This is our intermediate term low. The reverse is the case when we talk about an intermediate term high. An intermediate term high is a high that has a lower swing high at the right of it and a lower swing high at the left of it. This is also a swing high as well. So this one becomes or is our intermediate term high. Now, intermediate term high is being confirmed when we have two short term highs. Sorry, when we have a short term high, I beg your pardon, when we have a short term high at the right of it here and the left of it. Now, an intermediate term high or an intermediate term low is confirmed when we have two short term ranges. Yes, two short term ranges. What's the short term range? From this swing low to this swing high, this is a short term range. From this swing low up to the point where we broke market structure that confirms the trend, this is also a short term range. You get? So 1 and 2, two short term ranges confirms this intermediate term low. You understand? The same thing to two short term ranges. We have a high here. Look at price moved down. This is a range. And we now move down again. This is a range. So we have two short term ranges. 1 and 2. You get? Now, the short term range is being confirmed or is strong, is a strong short term range. Let me use that word. Is a strong short term range when we have a fair value gap in it. There's a fair value gap here and there's a fair value gap here. Now, this is a fair value gap. This is a fair value gap. So, first range and the second range. So these two short-term range, they have fair value gap, which now confirms that this is an intermediate term low. The reverse is the case when we look up. We have this swing high, that's intermediate term high, confirmed by this and this. Now, Take note, we have short-term ranges or short-term highs when we are going down. So once an intermediate term high has been confirmed, our short-term highs we hold until we get to an intermediate term low. Take note, all short-term highs holds until we get to an intermediate term low. Now look at this. This is an intermediate term low. The lowest one where we have 1 year and we have 1 year. Look at lows here. So this one is an intermediate term low. So if we extend this out, we see that from here, price took it out. But before we got here, price did not trade above this high. See, we went down, up, and then we went back up here. Just a bit, just a little peep, and then price went down, creating this a swing high, which is a short-term high, coming down again till we take out this intermediate term low. Now, whenever an intermediate term low or an intermediate term high is being taken out, we usually experience a deep retracement to at least 50% of the price range from this intermediate term high to this intermediate term low. Okay, so let's progress, which means that once we have two short-term range here now, 1 and 2, once this candle or once price breaks structure closer to the candle body, it means that this intermediate term low has been confirmed. So short-term lows will hold until we take out this intermediate term high. Now the short-term low in this price leg is actually this, or was actually this. Yes, was actually this. So say that price did not actually trade beneath this after it has been created 1, 2, and 3 by this candle. This trend is actually a strong trend up. So we now took out the intermediate term high there, of which price we progress upward, you see. And then this year we now created another intermediate term high here. Yeah, this is an intermediate term high. And then this is it. Short term high, short term high, short term high. Now price move short term range. You see, look, we then moved down, but we didn't break below this. Went back up, pull back, then we came and we broke below this. So in as much as this is a kind of consolidation, but we broke down to confirm this intermediate term high, of which after that price didn't waste much time. We created another intermediate term low here, 1, 2, and 3, this candle. Then we went back up. Look, this is also an intermediate term high, 1, 2, and 3. Good. So look at it. Went down, pull back, or retraced. Then we went down here and we retraced. Now price went up here. If you observe what happened, once we created this short-term range and this other move that confirms this intermediate term low. Price moved up and then target this high, after which we had a deep retracement. Are you seeing? We had a deep retracement. So this intermediate term high was confirmed by this price movement when we went back down here. Look, one and then two short-term ranges. Look at the first, a range, another one, a range. So this was confirmed because we have one, two, and three here. So we expect that this short-term high is going to price will not trade above it until we get to an intermediate term low. So all short-term highs will not be traded through until we get to an intermediate term low. Now, once we got to this intermediate term low, what do you observe? After a while, we had what? A deep retracement. Now, mind you, we must ensure that the time frame that we are looking at is in context of the time frame above us. What do I mean? We must ensure that the time frame is in alignment, is in order with the time frame above us. Okay, let's look at something now. Now, let's observe this particular price level. Now, if I observe this particular price level that I just drew here, look at this horizontal line that I just drew, this line, this intermediate term low that was taken out by this price movement here. Let's scale down to the daily time frame to see what actually transpired there and what made this price to reverse at this point. So let's go to our daily chart. So on our daily chart, this is the price level here. Look at it. Look at it here. You see. So observe that we had an order block here. So price reacted at this order block. That's what caused it to reverse. So you see, price reacted to this order block from here that overlapped with this fair value gap. Look at this high overlapped with this fair value gap. 1, 2, 3. This is a gap. This is an order block. So this was what caused the reversal or the formation of the intermediate term low on our 4-hour chart. Let's go back to our 4-hour chart so we can see it clearly. Look at it. You see. All right. So that's it. So once we create this intermediate term low, you observe something that we moved up again. You see, and so on and so on. So remember that whenever we create an intermediate term high, short-term lows will hold until we get to an intermediate term low. Short-term highs will hold until we get to an intermediate term low. The reverse of the case is when we create an intermediate term low. Short-term lows will hold until we get to an intermediate term high. Now, once we get to an intermediate term high or intermediate term low, we usually experience a deep retracement. Now, why is this important? It's important because the best entry is usually between intermediate term highs and intermediate term lows. I repeat, the best entry is usually spotted between intermediate term highs and intermediate term lows. And once we are trading within that intermediate term range, that from intermediate term high to intermediate term low or intermediate term low to intermediate term highs. We don't expect short-term highs or short-term lows to be disrespected. That's the price to trade above it. That's when we are bearish, or below it when we are bullish. If that happens, usually we have a key level in one time frame above us. Take note, we have a key level in one time frame, or at one time frame above us. So that's just it. Is as easy as that. So tell me what you think about the video, and if you have any concern or any questions, please ensure you ask your questions. Yes, the comment section is also open. I'm going to also dig more or dwell more on this video as well, or on this particular topic as well. Thank you so much.